I'm back on the road after a great weekend of golf. Looks like I have this entire train more or less to myself. Great time to get some work done.
All right, folks. So to start off this week, I want to go through a couple important points that I think we need to keep in mind. One, given seasonality. If you remember a previous video I did, I believe last week, I talked about or 2 weeks ago, about the seasonality of October. October being a month where we do tend to see at least one significant volatility spike. That's number one. And number two, earnings season. We're coming into this week now. We had some bank earnings last week and some other ones, but this week earnings season really starts kicking off in earnest. So we want to be prepare for that. Okay. So the number one thing I want to go through is the fact that if we look at the S&P 500, although we did have this breakout in July, the reality is that we're now like 13 weeks or something, and this market has done nothing. Okay. Yes, we broke out, and so far we are still consolidating above what used to be resistance. Okay. But it has been unbelievably boring since. So I have spoken with people last week. I met with people in foreign exchange, so FX. I met with people on the institutional front on fixed income. Of course, I talked to equity guys, and almost in every single one of these asset classes, people are bored out of their minds. Okay, because it's just that boring. Now, usually when I hear that type of behavior or that type of moaning, we are getting closer and closer to a point where we start to have a more interesting market. That could be a rally and breakout. It could be a faltering apart and then maybe ultimately a U-turn into year end. It's all possible. The point is we need to shake ourselves out of this point here at some point. And so let's have a look. So again, S&P 500 consolidating here, and the longer we consolidate above here, the better. But at the same time, until we have a resolution in one direction or another, directional trades right now are very, very difficult to do. So just keep in mind, if you're going to do a trade, make sure you understand for the big picture, the S&P 500 itself is stuck in a range. Now, again, this could change today. For all I know, it could change tomorrow. It could change next week. But until we move in one direction or another, we are stuck. Okay, that's point number one. Point number two is, if you look at some of the sectors, like for example, last week, you look at the XLV. This is the healthcare sector of the S&P 500. I'm just going to give you guys the weekly chart so you guys can see. 2 points to make here. Number one, last week was an ugly week. Okay, and we're seeing more and more single name stocks and sectors and groups start to behave a little bit more like this. Now, this was a bit of an extreme, like a sort of one of the worst sectors last week, if not the worst sector. And you can see a big sell-off. Now, the S&P had a bit of a downdraft too, but we remain stuck in a range. But more importantly, keep in mind that while the S&P 500 broke out this summer, the healthcare sector did not. It made a lower high, excuse me. If we look at the XLB, for example, material stocks, lower high. Okay, same thing here. Look at the financials. No doubt, lower high so far, right? Energy, obviously a lower high. The only things that really looked fairly attractive are some large cap tech. Okay, and that's really what this S&P 500 market right now is to a good extent is sort of leaning on, is large cap tech, Amazon's, Facebook's, those kind of names, and rightly so. These are growth stories and they're great. However, we have to understand that a market can't push higher on just a few stocks alone. A market might be able to stagnate and not do anything, which is exactly what the S&P has done, but it can't really essentially move higher until you have broader market participation. One more thing, guys, and this is an interesting thing. I spoke with a lot of folks last week about this, and a lot of people that are very bullish on biotech are very much ignoring the fact that biotech, since the 2015 highs into the January, February lows of this year, corrected. Here, you can see it, corrected about 40%. And ever since, we are having these rally attempts. Really, we're not getting anywhere. Like, for example, the IBB biotech stock right now, biotech ETF is continues to be stuck in a year-to-date range. We had a breakout attempt that ended up being a fake out 2 times in a row now. So we're now right back into this middle of this range that we've been here all year long. Let me show you guys one more thing. If we add some medium-term moving averages on this, look at the red moving average. That's the 200-week moving average. We're once again coming down to that moving average. And now I don't think this is going to snap below in a second, but once if the S&P or the IBB ETF breaks below this, things could start to get very, very hairy very quickly. Look how it first broke below the 50-week moving average, that's yellow line. Then it stagnated above the 100-week moving average. That's the blue line. Then it ultimately broke below there. Now it's doing the same thing here. Okay, keep this in mind. It's very important. This week we are having the webinars for my B2 reversal indicator. Okay, the B2 reversal indicator, please sign up for the webinars at the bottom in the comment section. You can sign up for the webinars. I believe it's this Wednesday and Thursday, October 19th and 20th. Make sure you sign up. Last Friday, for example, I guess that must have been the 14th of October, or actually last Thursday, excuse me, we got a buy signal in stock ticker symbol IMAX. And the stock proceeded to rally 5% the next day. These are the kind of very, very powerful signals that my B2 reversal indicator will give you. Make sure you sign up for the webinar this Wednesday and Thursday down below. I hope this was helpful, guys. I'll see you in the next video, and I'll see you in the webinars.